Welcome to Alpha Recap, your market wrap from stockalpha.ai. Glad you could join us. Markets closed up today on an AI-led risk-on session. And as always, if you have questions, you can reach us at stockalpha.ai.
Nice to be here. Big day to unpack. A lot of headline moves, some juicy company beats, and then the macro print that reminded everyone that the Fed story is far from settled.
Totally. What really stands out here is that the day felt like a tilted table. AI infrastructure names lifted the market, but underneath there were plenty of mixed signals.
Yeah, that tracks. Let's start with the obvious. Dell absolutely popped and was one of the clearest examples of that AI narrative driving real stock moves.
Right. Management reported AI server revenue up 757% year over year, and profit metrics that beat expectations by the widest margin in about 5 years. That drove huge flow into the name.
And traders reacted. There was an intraday jump reported at about 19%, which is dramatic for a name that big. That number, 757%, really grabbed headlines and helped set the tone.
Snowflake was the other standout. It surged about 34% in a single day after results tied to Amazon Web Services momentum. Analysts pointed to Snowflake's role in data warehousing for AI workloads as a core reason for the move.
It was a classic example of a high-growth software company getting a re-rating when cloud linkages look strong. Momentum indicates strong demand for AI-related data services, but analysts also cautioned about sustainability and margin mix.
And Microsoft-related flows were a key part of the story. Market commentary flagged roughly $6 billion rotating toward growth in AI-oriented names, and indexes finished the day higher, about 1% on one benchmark and about 0.5% on another.
Right. And the other thing is Google showed up in the narrative too, with cloud partnerships aimed at accelerating AI adoption. It wasn't just hardware and data, it was platform tie-ins that reinforced the theme.
I mean, when you step back and look at this, the mix of demand beats, like those Dell and Snowflake results, plus big money flow, created a kind of feedback loop that amplified the moves.
But there were real caveats. Analysts repeatedly said one quarter or one partnership doesn't equal long-term cash flow durability. And enterprise AI adoption timing matters a lot for sustained revenue.
Let's pivot to retail, because it was one of the more headline-driven parts of the tape. Kohl's produced the best comparable store sales growth in about 4 years and spiked roughly 20% intraday. But revenue actually fell year over year.
That's an important nuance. The move reflected momentum on comps rather than a clean top-line recovery. Short-term traders loved the inflection, but long-term investors have to parse whether store economics and margins actually improve.
Best Buy beat on both the top and bottom lines, which analysts said shows tactical and strategic fixes are working. And Costco posted same-store sales up 9.8%, with gasoline playing a big role in traffic and ticket size.
Commodity-driven mechanics at work. Higher pump prices can inflate membership retailer metrics, even if underlying retail demand is more mixed. So headline strength, but with a caveat on sustainability.
Short reactions.
Not what everyone expected.
Big move. We should talk about small caps next, because there was a real tension there. The small cap benchmark had been outperforming, but Wells Fargo issued a sell view, pointing out prices were up while earnings estimates actually slipped.
And that matters because rising prices with falling earnings compress forward multiples. Small caps are more cyclical and more sensitive to credit and liquidity shocks, so analysts warned the rally could be vulnerable to downgrades.
Right, it's a classic divergence between market breadth, buyers flowing into risk, and fundamental watchers who see a valuation squeeze. So while momentum funds may have enjoyed the move, it's not without downside risks.
Which brings us to the macro print that probably kept a lid on some optimism. Core PCE, the Fed's preferred inflation gauge, held at 3.3% in April, exactly in line with expectations.
That reading matters for 3 big reasons. 1, it keeps the Fed's gap to its 2% target wide and preserves a higher for longer narrative on rates. 2, equity valuations, especially long-duration growth names, are sensitive to real yields and discount rate moves. 3, sectors will respond unevenly to a sticky rate environment, versus a clean disinflation story.
Analysts noted that even a 25 to 50 basis point move in terminal rate expectations can materially reprice multiples on high-growth firms. So a sticky core PCE leaves downside risk for stretched growth valuations.
Yeah, absolutely. The market's risk on tone didn't erase the underlying macro reality. So you had the duality of strong AI demand signals blended with persistent inflation uncertainty.
Another interesting subplot was about narrative volatility. The Dan Loeb disclosure about being fooled by Sam Bankman-Fried while holding positions tied to Elon Musk got a lot of attention.
It was a reminder that reputational headlines and social media narratives can generate idiosyncratic volatility independent of fundamentals. Wild times.
Markets react to stories, not just spreadsheets, and that creates extra trading noise on top of the macro and earnings signals.
So where did analysts broadly agree and disagree today? Agreement was straightforward. AI demand materially contributed to leadership. Dell's 757% AI server growth and Snowflake's cloud-linked beat were cited as primary drivers. Also, core PCE at 3.3% keeps the Fed story intact. And retail headlines were driven by sales momentum rather than uniform fundamental improvement.
On the flip side, there was debate about sustainability. Some see the Dell and Snowflake moves as validation of a secular AI opportunity. Others caution these are early cycle data points. Order book durability, supply for GPUs, OEM capacity, and margin pressure will decide the long-term outcome.
And with small caps, the market is buying risk while Wells Fargo warns about estimate downgrades. A pretty direct disagreement about how fragile the current risk-on posture really is.
Right, so what does this mean for different investor types? Quick guide. Growth and momentum players benefited from today's action because flows and headlines amplified returns. But that also raises reversal risk if sentiment changes.
Long-term growth investors should reassess valuation inputs and adoption curves. Exceptional revenue growth in a quarter should be tested against sustainable margins and capital intensity for scale.
Value and income-focused investors are still watching inflation and rate uncertainty. Sticky core inflation supports a premium on cash flows and dividends. Retail comp inflection is interesting, but top-line durability wasn't uniform across the group.
Risk-managed and institutional allocators heard a loud signal. Flow-driven rallies and deteriorating earnings estimates, especially in small caps, argue for disciplined sizing and scenario analysis on estimate revision risk.
Analysts also gave a practical monitoring checklist. Watch order books and backlog visibility for AI hardware names. Track partner and cloud tie-through metrics for data and software players. Keep an eye on Fed communications and real yield moves. And follow analyst revisions in small caps and select tech names.
Also monitor flow indicators, like that about $6 billion signal we mentioned, because liquidity swings can amplify sentiment quickly and lead to sharp reversals.
So, what really stands out here is that the market displayed both narrative momentum and macro caution simultaneously. That's not unusual, but it does demand active monitoring.
I mean, when you step back and look at this, it's an example of opportunity and risk coexisting. AI adoption is accelerating and getting priced in, but persistent inflation and mixed breadth leave room for reversals if earnings revisions or rate expectations change.
Short wrap reactions.
Watch order books.
Watch Fed comments.
Key takeaways before we sign off. 1. AI infrastructure and cloud linkages drove a clear risk-on move, highlighted by outsized company results. 2. Core PCE at 3.3% preserved a higher-for-longer rate narrative that keeps valuation sensitivity alive. 3. Retail headlines were momentum-driven and not uniformly fundamental improvement. And 4. Small-cap strength is at odds with earnings estimate trends, so the rally could be fragile.
And a final reminder, this is informational analysis, not personalized investment advice. Analysts note risks and opportunities, but this isn't a recommendation to buy, sell, or hold any security.
Thanks for listening. If you have questions about anything we covered today, head to stockalpha.ai where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai. See you next time.